But, Joe, I'd like to discuss Fed Chair Jay Powell, who today faces one of his most difficult challenges, defending a Fed policy that's arguably the most aggressive in history amid a dramatically improved economic outlook. Let's look at what's changed here since the Fed last met. We got the $1.9 trillion in relief enacted by Congress, signed by the president. It's prompted a surge in growth forecasts. Vaccinations have accelerated. States have started to reopen. Bond yields have soared, and inflation concerns among the leading market worries right now. Meanwhile, the Fed's zero rate and aggressive policies on QE, they haven't changed. Powell and other Fed officials say they're going to keep them in place until the economy regains most of the 10 million jobs lost from the pandemic and inflation runs above its 2% goal for a time. So the focus today will be on how much more optimistic the Fed's own forecasts become and how Powell defends no change in policy. The Fed is likely to hike, for example, its growth outlook for this year. It had forecast GDP around 4% for this year. Our CNBC Fed survey, around 6%. With no rate hikes expected this year, the focus turns to the median Fed officials' forecast for the funds rate in 2022. Fed looks for no hikes. Our CNBC survey, nearly 2 full hikes with a 0.45 funds rate forecast. We reported that yesterday. Bank of America, Michelle Meyer writes, Powell and forecast revisions will seem more upbeat. This will likely be the Fed's first step in a less accommodative direction, but Barclays doesn't think so. They say we expect the Fed to rein in policy rate expectations in March, with the median dots, that is the Fed's forecast, still showing no liftoff through 2023, despite an upgraded outlook. No Fed has ever run so aggressive a policy as this one, and so no Fed has ever had to engineer an exit from it. The question is whether Powell can keep yields at bay for now and avoid a temper tantrum, Joe, when he moves to tighten.
Shepard Smith here. Thanks for watching CNBC on YouTube.